Hello everyone. Welcome back to yet another session. Welcome back to yet another session. The topic, the cash. The cash is king or trash. We'll try to find out in this video. In current scenario where the interest rates are so low as far as our savings account, bank FD, RD or even corporate FDs are concerned, you cannot afford to lose the value of our holdings as cash due to inflation. So understanding cash and how to handle it well is very important to beat the inflation and also to earn intelligently as well. So basically what is cash? Cash is ready money, assets that can be liquidated or converted to cash within 3 to 6 months. So it's not physical cash but also liquid assets. So is cash trash or king? That is our question today. As per me, cash is king, but is definitely a trash if held on to a longer term as cash. Let me decode this in a simpler language. Before this video, I recommend you to listen to my video number 18, 19 and 20 on how economy works. RBI is printing money to lower interest rates. Printing money leads to more liquidity in the economy. Due to lower interest rates, people can borrow more money. More money means for any product, people are willing to pay more as they have enough money with them. With more people, with more money, and hence limited supply of products, the cost of the product will go up. See, all of this concept we have already discussed in detail in the sessions 18, 19, 20, which is how economy works, but I am just brushing you up, or maybe somebody, if you have not seen that videos, I am trying to shorten the video and tell you those concepts. Going on, people, as they already have cash, buys the product at that higher rates, leading to inflation. So the original 1 rupee we had will so worth less than that original it would have been able to buy. So the original 1 rupee we had will so worthless than that originally it would have been able to buy. So if RBI prints money, which they have been doing to boost our economy, is actually bad for those who hold cash, as cash won't appreciate over time but only depreciate as explained above due to inflation. So again, obviously you can correlate all these things in the current scenario. So days back, RBI had increased the repo rate by 0.4 or 40 basis points. So this was again to gradually arrest the inflation. So inflation had been caused due to lot of money spending or money incorporation by RBI or the central government into the economy to boost the economy during the pandemic time, wherein people had lost job, was having medical emergencies, were not doing good at job, so or even the businesses were down. So it's the government's or RBI's policy or the responsibility to boost the economy by punching in or pumping in lot of money. But this, as the pandemic is almost sort of over, but now this left up with high inflation. So this is not only for RBI or the central government or India. This has happened in all over the world, including US also reporting very high inflation rates. So again, my videos 18, 19, 20, how economy works, really stands good here. So as explained above, to revive the economy, RBI lowers the interest rates, especially while recession or market slowdown like that of what we saw while the COVID pandemic hit us. This lower interest means our cash assets will not yield good returns, including the bonds and the liquid assets. Note that RBI controls the repo rate to control interest rate. Repo rate is nothing but the rate at which the central bank, in our case RBI, grants loans to commercial banks against government securities. Reverse repo rate, on the other hand, is the interest offered by RBI to banks who deposit funds with them. Don't confuse repo rate with CRR. CRR is nothing but the cash reserve rate. This time CRR also is increased by RBI, if you have seen the news. So CRR is nothing but minimum amount in percentage of cash compared to banks' total deposits. Commercial banks has to hold this deposit as a reserve with central bank or RBI, which doesn't earn any interest rates. So whatever is collected as fixed deposits or such sort from the various public, whatever amount, X amount, out of that, this percentage of amount will be kept as a reserve with the RBI, central bank. So this actually doesn't fetch any business or revenue for the bank. So if that is increased, it's good for the fund, the holders or people who have invested in the bank or deposited in the bank, because it solidifies the uh, uh, strength of that bank, because there is some reserve against your deposits. But for bank, it doesn't fetch anything because they cannot give it out for loan or something, because that is stuck up with RBI. As I am explaining CRR, let me explain out of interest another terminology, which is SLR. SLR is the statutory liquidity ratio, which is a minimum percentage of liquid assets or deposits that a commercial bank has to maintain in the form of liquid cash, gold, or other securities or bonds. And these are not reserved with RBI but at the respective banks only. SLR is fixed again by RBI. So CRR regulates the flow of money in the economy, whereas SLR ensures the solvency of the bank. So again, if you decode this, CRR regulates the flow of money. So how it regulates? Because whatever it is getting from the depositors, they are not allowed to give it back as loan, which is like pumping money back into the economy. So if the CRR is increased, the liquidity into the economy reduces. So hence the inflation also comes down. So that is how RBI has this time increased the CRR as well, so that liquidity in the economy reduces, thus trying to control the rising inflation. So coming back to our topic of cash, as per the philosophy I explained here, it's clear that as you remain in more of cash, it will only erode your wealth. Even the liquid assets like bonds will lower in value, which is price, as the inflation increases, as the interest rates drop, finally eroding the cash holding value of the investors. But there is another contradicting viewpoint for this concept, the viewpoint of great investors like Warren Buffett. Warren Buffett's Berkshire Hathaway has a cash holding of around $140 billion. That's more than 30% of Berkshire's holding. So that's so huge. As the stock markets rises up, inflates in prices, and finally the bubble crashes, or some opportunity investments like pandemic strike, etc. happens, and you really need to have liquid assets or cash to liquidate immediately and invest in bargain hunts of those undervalued quality stocks. So currently speaking, currently also speaking, the market is sort of in a lower side, and it has crashed from its all-time high. So these are like opportunity moments wherein if the market crashes, you should have some liquidity so that you can invest at much discounted prices in value stocks or stocks which have fallen down so much below because of this overall scenario, market panic selling, this Russia Ukraine issues, pandemic, inflation fear, everything. So such things are of no concern on a longer term for you, but on a shorter term, if you get the stocks at a undervalued or low price ticker, you really need to look at it and invest. For investing, you need to have money, liquid assets. So for that, you need to have cash. So that is the other viewpoint of it. So that you become a true value investor by buying when others sell, and as always going against the herd mentality. So concluding, we need to have a balance of cash or liquid assets in your portfolio to the other long-term assets or investments, so that we don't miss the train as bargain hunters or true value investors. So regarding the cash holding, I always suggest a liquid asset for opportunity investments. So either you can invest in liquid bonds, or even in that case long-term bonds as well, or maybe company FD as well, wherein you get decent returns. And again, while selecting these, you need to see the undervaluing assets and ensure that it is good and it doesn't go broke, and that your investments are safe. And whenever you want to invest in value stocks or bargain hunts, then you can liquidate those assets and invest wisely. Happy investing.